Hello, welcome back. Mike from Canavan Wealth. I want to do a quick video here about tax implications of owning stocks and bonds. There is this article that's going to be going up. This came from the marketing department. Very good article, very kind of low level in terms of how interest, dividends, and capital gains work. If you're not very knowledgeable about what the taxes are that you pay on investment, this is a very good article to get you started. But I actually want to use the opportunity to talk about something a little more nuanced that affects a lot of my clients and a lot of kind of future clients, which is the nuances around capital gains and ETFs and mutual funds. So this talks about capital gains. Capital gains are when you buy a stock, let's say at $100 a share, and the value of it goes up to $130 a share over some time period. You sell it, you made $30 per share of stock you own. You owe capital gains taxes on that if it was outside of a retirement account. Of course, IRAs and Roths work a little different. The article covers that. Most people kind of understand how Roths and IRAs work. But if you just own that in a joint or single name account or something, we often call them TOD accounts, transfer on death accounts. These are accounts that are taxable kind of as the gains are made. And in a mutual fund, which have been popular for years and years, when the fund itself buys and sells something, they actually pass the capital gains on to the investor, and the investor owes those capital gains that year. And that is how most people are used to it, but you don't control it. So, for example, 2021 was a particularly terrible year for capital gains for most people as their investments went up. Those companies ultimately ended up selling some of the stocks inside their mutual funds, and they passed those capital gains on. So at the end of the year, even though you may not have taken any money out of your account, the capital gains got passed on to you through mutual funds. And there were big capital gains taxes that year. Last year, similar thing happened, even though the market was down. So even though the market's down, there may be some stocks, like energy stocks or something, that those companies are selling at a capital gain, and they're passing that capital gain on, and you actually owe capital gains on something that, even though it went down. And now this all works out in the wash at the end, other than you don't control it, right? So ETFs have come along in the last, I don't know, they've been around 10 years, I feel like, but probably more than that. But exchange traded funds, these are kind of a new wrapper, much like a mutual fund, where you buy it and sell it more like a stock. So if people don't know, mutual funds, you buy and sell at the end of the day only at a closing price. ETFs, you buy second to second, just like a stock. And unlike mutual funds, they do not pass through the capital gains that they kind of accrue in the fund. Those are effectively part of the price. So you don't receive the capital gains until you buy it or sell it, just like if it was an individual stock. And that is dramatically different than mutual funds, and probably the biggest thing that people do not realize about them. And both systems can be good, and there can be reasons for them. For example, mutual funds, their cost basis, which is kind of how much you would owe in taxes between when you bought it and sold it, the actual mutual fund, not the stocks inside of it, they tend to stay fairly current. So if you end up needing to take a lot of money out of your account, there's often not that much of a tax burden because you've kind of been paying the taxes as you go. Whereas an ETF, if you've held it for 10 years, you can accrue quite a bit of capital gains, and you go to take the money out and you realize that there's this big tax bill due. Probably the other big thing that people really need to understand is that under current law, if you pass an equity down, if you die and pass an equity on, the cost basis gets reset. So specifically for ETFs, if you don't ever plan on spending the money, they're very tax efficient because you're not paying capital gains as they accrue. And when they pass to whatever beneficiary you have, the tax basis resets. Unlike a mutual fund where you're kind of paying it as you go and you don't get as big of a benefit there. So I use both strategies for different clients based on their tax situation. But for people who are very tax sensitive that are near some type of a limit, right? There's all sorts of like earning limits for like Medicare and a few other things. ETFs do give you a lot more control over where the taxes come from. However, you can work yourself into a situation where you're always selling something that doesn't have capital gains on it until the point comes where there's just nothing else in the portfolio that has no capital gains on it. And no matter what you do, if you're going to sell something, you're going to have to take capital gains. Whereas mutual funds, they tend to move a little bit more with the market. There's almost always something you can sell that doesn't have capital gains on it. However, you're going to be paying some each year. So article is going to go up here on the website. It's very good as kind of a rudimentary approach to how interest, dividends, and capital gains. But I thought I'd kind of spice it up a little bit more with something that I think is a little bit more nuanced and meaningful to my clients and prospective clients about mutual funds versus ETF exchange traded funds. So if you have any questions about this, you can just email me at mike@canavanwealth.com or on the website, canavanwealth.com. You can schedule an appointment, phone call, or whatever it is if you think that this might be pertinent to kind of how your portfolio in particular is managed. I hope this has been informative, and I will talk to you soon. Thank you.